Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Joel Prussky, our OIS and cross-currency trader. This week's episode is titled 2026 House of Cards. I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Joel, welcome back.
Thank you, Benny. Good to be back in the seat.
Good to be back in the, yeah, okay. Same seats as always. I think you have the same one at your desk, so.
I do?
Probably. Where do you see things right now, Joel? We have just come out of the Bank of Canada having their policy decision staying on hold, the Fed cutting rates another 25 basis points. We got double U.S. payrolls this morning, Canadian CPI yesterday. It's currently Tuesday. What's the state of things for both central banks at this point and for the front end, both in Canada and the U.S.?
Well, I mean, I think, the Bank of Canada has been pretty clear the last two meetings, and today there was a speech by Macklin. I mean, rates are appropriate. We have a moderate growth going on right now. Inflation is still higher than I think they'd like. And they were one of the first banks to cut, so people kind of forget that, right? And I think because of that, I don't think rates in Canada are going anywhere for the next 6 months. I mean, I don't claim to be smart enough to know what's going to happen after that, but I would say for the next 6 months, it would be fairly unlikely that rates move up or down in either direction on an administered basis. I am wary, having lived through 2022 and still having some of the scars that haven't healed, as to what can happen when the macro narrative changes in Canada. And if it turns out that inflation doesn't get much lower and growth is okay, that maybe we over-eased and there could be a market reaction that could change that. But I think that's a kind of late summer, early fall story.
Okay. Let's stay in Canada. So the risk of them having gone too far is not a near-term risk? Is that what?
Well, I don't think you can tell that, because you need at least another couple, I'd say 3 more months of data, and they have to really see what inflation's doing. I mean, they really are hanging their hats on inflation going back to target. Which measure of inflation, whichever they decide is going back to target. But if you as an economist and me as a trader and the collective wisdom of everyone else realizes that all their other measures are sticky at 2.8 or 2.9, then you can't say you're anywhere near your 2% target. And that what do you do if that's the case? And more importantly, I don't know, it's more what the bank does. It's what does the market do? Because none of us are waiting around for the bank to put us in or out of our positions on the day that the meeting happens. We're market makers and we're flow driven. So if the wisdom out there is Macklin needs to hike again, the flows could overwhelm the market, as we've seen in the past.
So here's the problem. You said we need 3-4 more data points, months of data. But here's the problem. The CPI numbers in particular are going to be more volatile than they should be. So we're going to have the reversal of last year's, let me call it, stupidity around CPI. We had the GST, HST holiday, so that got cut right before Christmas. And so you get the base effects of that unwind for December, and then January is a little more normal. Then February prices went right back up. And so you get, again, the reverse of that in February 2026. And then in April, we had the carbon tax, the consumer carbon tax cut, which then cut inflation by about 0.7, give or take, 5 to 0.7, let's say. And so again, that goes right back up. So you're going to have all these headline, at least, pretty clear. Headline inflation, at least, is going to be way more volatile than normal. Lots of ups and downs over the next 5 months. I guess we can look through that, but I suspect the bank is going to be a little bit more sensitive to headline inflation generally. They are facing the inflation target renewal this coming year. That whole thing doesn't really come out till toward the end of the year, but They've said very clearly, and it was just in a speech, that they're not backing away from the 2% target, not even on the table, not a discussion. And I would guess that they're going to focus a little bit more on headline inflation than on core. And if you have all this volatility, it's hard to make heads or tails of things. So whether it's strong or not, you don't really know.
Okay.
I do think things are on the stickier side. The tax stuff should honestly wash out. That GST, HST should be largely irrelevant. But the carbon tax is important. Like that goes up. So April 2026, headline inflation goes up 5 to 7 tenths.
Well, we have to look at the other data too then. I mean,
that's it.
Let's see if the jobs stay strong. I mean, if we give back 150,000 jobs in the next two meetings, I think, again, I don't think it puts cuts in play. And I don't think there's much left in the curve. I mean, July is trading at 230 versus a 225 target. I mean, you're getting paid 5 basis points for the next 7 months, 6 months. Like, it's not a lot. It's not a lot to get excited about. And if rates were at U.S. levels of 3 or 3.25, I'd say, okay, maybe you can get that. But I think we have to remember that we're running real rates are negative in this country.
So,
according to how I measure inflation, but
that's fair. I mean, even according to how everyone else measures inflation,
well, I don't know.
You pick the core measure.
I think the bank likes to pick the one that's
negative.
the lowest, and they would argue that rates are positive because of one of their measures is 1.8% of the 14 that they measure.
So the growth risks, you said, if we give back 100,000 jobs or whatever, you don't think that matters, I guess? So like, I would still say the growth risks are on the downside.
Because of trade tensions?
Because trade is still an issue,
sure.
and you're still seeing the ripple effects of all that, and the uncertainty is still there. I mean, it's reasonable to say the bank has called the economy resilient. I get that. I'd say it's more that like the worst case scenarios that everyone thought would unfold after all this trade stuff started to happen has not happened.
But arguably, 2.25 was pricing in some of the worst case. I think 2% should be the floor of rates. I think going back to the old days of zero was a crime against finance, literally. It was a war crime against finance. And I still maintain to this day, 2% should be the lowest we get. So if we're at 2.25, we're almost at where things should be. And we were always assuming the worst case. I mean, we sat here and everyone was like, Trump's going to screw us and this, and all this stuff. And the bank was aggressive, as it was the right thing to do, to cushion the blow on the way down.
I was going to give you credit about that 2% thing because you have said this many times before.
Only for 10 years.
On this show also. Not for 10 years, but on this show in particular. Good job.
Thank you.
2 is the new 0, and that's pretty much seemingly where we are. 2 is the new floor for rates. Is probably the better way to put it.
Yeah.
So no more downside. Like there's still a tail where things go really pear-shaped. And in that scenario, we still do.
Sure.
Okay.
But I think where we are now is we've come so far from the possibility of that tail. Whereas if we just meandered along, it would still exist. That tail risk would still be, that left tail risk would be much higher.
Yep.
Than I think. And what we've seen over the last 3 months is, wait a minute, that left tail risk is much lower. That's not to say in 3 months it might not be, right? If all those jobs that we thought we had from Stats Kent come out, and all of a sudden it turns out that was just a mirage, then maybe we are, bouncing along the bottom, and maybe the economy will need more support, especially if USMCA blows up. But there's so many ifs and stuff there.
That's fair.
And where we are now, like I said, I look at the meeting curve, and I think, in July 230, like there's so many more interesting places in the world to speculate on, and we've already seen it in our market. Most of the players have left just because there's not a lot to do.
Yep.
And they want to go to places where there are things to do. And then, so it's a pretty boring, the front end of Canada is pretty boring at the moment. I think it's going to stay that way for a while.
Okay. When do you think is the earliest they can hike?
I mean, I think it could be April, but I don't think it's likely. I think July is more likely.
Really? Okay.
I think only because I see what they did in Australia, and again, like it's such a different market than it's been for the last 15 or 20 years. First of all, the amount of capital chasing returns is huge. The amount of risk taking from the banks is asymptotically approaching zero. So you have a deadly combination of more flows chasing returns and less people willing to warehouse risks. So because of that, you've got more volatility around inflection points. And that doesn't mean that the bank could hike in April, but could I see us pricing in 15 of 25 basis points, if we had another 50,000 payroll and inflation was back up 2/10 at the next time, yeah, I could. And because the flows will dictate that.
Okay.
Could I see them actually doing it? Probably not. But again, 2022 scars. That's just the way it is.
Yeah, I'm far more skeptical of anything approaching a hike in the first half of the year. One, though, that CPI uncertainty is a problem for me. We won't get the April number until May, so you're not even through all this unknown until pretty much the middle of the year.
Okay.
And then you have USMCA waiting in the wings to get renegotiated, and I have no idea which way that's going. I'm hopeful that because there are midterm elections, the U.S. plays a little bit nicer generally, because I assume the Republicans will want a strong economy going into those elections. Maybe I'm wrong. Maybe they don't care. Maybe it just gets dragged out. Lots of different possibilities, but that's what gives me a bit of hope. And so toward the end of the year, I think Canada can get to a spot where they could be moving rates higher, but that's almost like the best case scenario. April or July seems wicked early, unless you get to 2022 and inflation really picks up a lot. But
well, that's why you gave me kind of like that. I answered your question.
That's your tail. I got you.
And it's more that the market will price it in, which is a market maker, is what I care about. I think the earliest the bank could probably respond is probably June or July, if that's the case. Okay. And then when we're out to October, like I don't think it's wrong to have October trading somewhere near 245, 250. It's not crazy because, again, like we forget positive slope curves are normal, and you should be getting paid the optionality of rate hikes, right? You should be earning that carry down. That's normal. It's not normal to look how the U.S. curve looks forever, which is super inverted, and every day you're long costs you money. That's not normal in a historical sense. That has to do with the speculative frenzy of gambling of most traders and dealers.
That you facilitate.
That we facilitate, sure. I mean, we're the house. We don't care who comes in.
Had to.
We don't care how drunk you are. As long as you're betting, we're probably there to facilitate.
Okay. All right. You're a little, I guess you're more anticipation of where the market is. And I think just in reality, it's just October, fine. I can see you pricing something by then, just because like Q4 is
a long
right
way
there,
away, right?
and that's fair. But I don't know. First half of the year, the risk
10 months from now, a lot of things can change. I mean, this is the beef I have with the dot plot.
Well, dot plots are stupid.
They got to get rid of that thing. First of all, the information the perception of what people input into the dot plot can change tomorrow after two sets of strong data. So why do we look at this and say, the traders are much more aggressive than the dot plot? The dot plot's a meaningless number.
I'm with you. I agree. So that backdrop for the bank, let's take a look at where the Fed is and where they're going. We're talking about not near term, but eventual bank hikes, maybe even in 26. The Fed is almost certainly cutting further.
I think you're getting at least two. I think you're getting at least two more.
Are they really going to move in opposite directions?
Well, I mean,
or is the Fed just going to be like done by the first half of the year, and then the bank could be the second half of the year, and that's kind of the way it's been. Where the bank,
I would say that's more likely,
first.
But I mean, the reality is they're converging, and historically, they've been converged more times than diverged. Mm-hmm. And I think Canada was just way ahead of the game because there was more risks facing Canada, and now the U.S. is kind of getting that lag effect of in the K-shape and everything like that. So, and I mean, everything the Fed's been saying lately says they're concerned about jobs, and that is their I mean, that's right in their mandate. Okay. And then you've got a president who has to run the economy hot going into midterms, or he's going to get slaughtered, who's shown very little respect for normal rules, so he'll do whatever it takes to get it. And I think that means getting at least a couple rate cuts in the U.S. So I think we're going to see for sure, we're likely to see 2 by April, I think. And then after that, it will depend on what the data is.
And who the new Fed chair is.
Yeah. But my whole thing is Powell should be cutting aggressively now just to get it down there so he can, when he walks out the door, he can flip the bird to Trump and say, I cut the rates. I did it at the right pace because inflation's now behaving and we're doing things the right way. And then you stick your new chair in, what's he going to say? Rates are at 275. Oh, we need them super low now? Well, not if inflation's running at 3%.
I guess that's inflation. It all comes back to inflation in both conversations, both central banks.
But
as it should.
Who's willing to tolerate inflation above target? A central bank that has a lot more political influence or Canada.
I mean,
Right? I mean, not that there's not political influence here. I mean,
not to the same extent.
no.
Not to the same extent.
So, and then what happens if we're moving to a world where, 3 is the new norm, or 2 3/4 is the new norm from when 2% was it? We're not really used to that. We've had 2 decades of disinflation. Mm-hmm. We're all used to that. What happens if it's 2.5, 3.5 is the new world? And I don't think the bond market, I don't think anyone's prepared for that, because it's been so long since we've had to think that way. And what if we can't get it to 2%?
We are not priced like that, to say the least.
We live in a world where no one would ever subject the economy to a deep recession to get inflation down. Volcker couldn't exist in the world we're in now.
Well,
he couldn't. There's no the system doesn't work that way anymore. First of all, it's too levered, so that's a huge problem. The entire house of cards is built on leverage, so the Fed can't raise rates aggressively, and the federal government can't pay their bills if that happens. On top of the fact that everything's based on asset prices, I mean, I fear for the bigger picture of what's going on in the world. I think there's way too much leverage. I mean, look what the Fed's been doing for the last 3 years. Buying back old low coupon bonds to sell current high coupon bonds because the dealers cry that they can't move the old bonds they have. That's because there's too many bonds out there.
Yes, well, that's and spreads moved, but yeah.
But so now we have new QE. RMOs, which is just really another form of QE, because they can't let the repo market get out of control. Because if funding goes bonkers and haywire, it's over. And I think they know that. Bassett knows it. I think Powell knows it. They understand how much the system's levered. So they got to keep playing the game until the game ends.
You used the term house of cards. So before we started, we discussed that a little bit, and you used that term. Can you maybe elaborate further? Is it just the fact that the funding is necessary to effectively enable the Treasury to issue all their debt, or is it like what?
And the basis trade, I think everything. I mean, look, we have gamblified society. I don't think that's a shocking statement. I've been saying it for a couple of years.
Oh, it's way worse now.
It's way worse.
Mostly because like sports betting is out of
It's
control,
way worse now, and it's starting at a younger age. But nonetheless, it's been going on for a long time. And why does nobody want off the run bonds? Well, because all they care about is flipping on the runs, because it's a gamble, right? It's a punt. They always want to punt. There's no real true demand for the amount of paper globally that's out there. I don't believe that. Now, could that change? Yes. If stock market corrects 30 or 40%, people might think, hey, 4% is not a bad little yield, when all of a sudden I'm not getting 18 or 17 or 15% on my, AI-related theme stocks or whatever it is. And maybe that could suck up some of that. But I think there's too much debt out there. Inflation's too high. And everyone kind of gets it. Like, I don't think anyone's saying that's not true. They just don't want to discuss it. And the key to everything is keeping funding low and stable.
You're only getting 18% on your AI stocks? You must be in the wrong ones.
I don't think I own any. But I do think the system is very precarious, much more so than we think it is.
What breaks it? What happens in 2026? Does it break in 2026, or I would bet we just keep going, at least for at least through the first half of the year. Like the Fed cutting just means more liquidity. Things are always fine. We have a whole generation of people that think Fed cuts solve all problems. So it will solve all problems because people think it. Until they're done.
Until it doesn't.
Until they're done.
Until it doesn't.
Well, until they can't do anything else, or until they're at a point where like inflation's higher and
well, I mean, I think if you listen to things like gold and silver and platinum and palladium, and they're telling you that something's broken in the system. And central banks around the world don't want treasuries anymore. I mean, the minute they shut Russia out of SWIFT was the signal that, wait a minute, we can't count on the U.S. treasuries as the base collateral for everything. So to me, that was kind of the big change. Okay, smart central banks were like, let's not buy any more treasuries. Let's diversify into other hard assets. I get all that stuff. We're going into a multipolar world.
Yep.
I think people who think China's in trouble are somewhat naive. I think they are out racing us in many ways, and they don't have the same roadblocks to getting things done because of the kind of state that they run. I think they're going to be a formidable. I don't want to say enemy. Enemy is the wrong word, but they are challenger to hegemony. Sure,
Yeah, sure.
And I think that's going to be a problem going forward. And they don't want any more treasuries. They have enough. I mean, their holdings have been going down for a long time now.
China's an interesting case. I find China to be fascinating and just trying to figure out exactly what their goals are. You seem to think it's to grow their power base globally, I assume?
Well, they were a huge world power for, 18 of the last 20 centuries.
Yes.
I mean, it's only the last 200,
Well, it's a lot of
150
people.
that they haven't.
There's a lot of people there.
And I mean, I think the U.S. is shown with America first, which is their prerogative, that changes things in the world. And someone's going to fill that void, and China's been wanting to fill that void. And I think the election of Trump's it kind of brought that more forward. And, American excellence is true, but it's not the only kind of excellence out there.
So my biggest question mark on China is their power base has been driven by exporting their way to prosperity. And what you have now is a not divorce, but quasi-divorce between kind of the West and the East. And so if there's going to be a increasing reluctance to purchase goods from China by Europe, by the US, by the developed world, can China sustain its model as it stands, or do they have to flip to a more consumption-driven model? But that changes the whole structure of society, which then changes potentially politics there. Like it has a ripple effect that goes on that, like, I'm not well versed enough in China to really know, but I think it would have big implications for how things evolve in China, and that's where I'm not sure.
Can it be both? I mean, the global South has 6 billion people.
Yep.
And I'm not convinced that the way America behaves, that the rest of the West is going to fall in line with America on the anti-China stuff, so that, they still have some consumers there. But I think, honestly, to me, I think Latin America is going to do great for the next 10, 20 years. I think there's a sea change and, away from socialism there that's going to help. And then China does have to say, we have to go to a more consumer-driven society. There's no doubt they have to pivot towards a bit of that.
Yeah, I'm not sure. You're seeing, there was an article in the Wall Street Journal yesterday, I think it could have been on the weekend, but I read it yesterday, about Germany pushing back against China as well, and the fact that they are kind of middle manufacturers have been hollowed out to some extent by China, just eating their breakfast at some extent. And that, I think that's the issue that all of these Western nations are going to come to at the end of the day, at least Europe and the US, that we've been happy to buy all of our stuff from China because it was cheaper, but hold on, we can't make anything anymore. That's a problem. And that's, so that balance of power is going to go back the other way. I just don't know how it ends up with China or not. What the end result is for China.
Populism
it's
in
not
the
just
West
populism.
but populism in the West is the question, because it's one thing to, I get that they say that, and then all of a sudden you say you want to start making things here instead, or in Germany, and then they're going to be 30% more expensive, or 20, or whatever.
So that's the other. I don't know the answer. Maybe AI and automation and all that stuff can make it not 30% more. Now, whether they can compete at the China level, I don't think so, because a lot of that, so the article notes, is just state-sponsored companies that are subsidized to some extent, at least, and that helps push the cost down.
I think they're trying to move away a bit from that, because now they've got the super, it's more of a winner. They're finding out who the winners are, and then, maybe you cut the blood flow to the non-winners and make the winners stand on their own 2 feet.
That could have been Germany just complaining. That could have been a German company just complaining. But
how about let me buy a Chinese car? I mean, I don't care. To all the auto workers who listen to this, probably 3 of you, I'm sorry, I don't care about Canadian auto workers.
I do.
I get it. You can.
I take the other side.
Your opinion. That's fine.
Yep.
I know we've disagreed on this many times. I want to buy a great car for $30,000, and I can't. I can buy a great car for $60,000.
Yes.
But I can't buy a great car for $30,000 because they won't let the great car for $30,000 in. And I've traveled all over the world, and I've rented Chinese cars in many places. And I'm not a fancy gearhead guy, but I want to drive a decent car for $30,000, and I can't.
I would say in 10 years you'll be able to.
At $30,000 equivalent to now,
Yeah, probably now dollars. I mean, it'll be the same there. There's going to whatever the global inflation rate is. That would be my bet.
Well, but in 10
I think
years, I
things
hope to
are
never have to drive a car again. I hope the automobile will drive itself for me.
that actually. Well, that's a different conversation. But last generation of kids to drive, in my opinion, is this current one.
Yeah.
Is my kids. And then after that, it'll just be Ubers for everybody. And buying a car is just a waste of money to sit in your garage.
Right.
And they can just auto drive you around.
I can't wait for that day.
But
But in the
you'll
meanwhile,
be long gone.
Ben,
It's like 20,
I'm
30
going to
years
live
away.
to 100.
Okay, maybe you'll still be around. So that's in like, what, 10 years? 2026 trade ideas.
It's a tough one. I do think, I mean, everyone's, on the steepener now. It's been, the curve has re-steepened significantly in the past 2 weeks, ever since the Fed kind of turned dovish. I do think this too much supply thing is just going to keep manifesting itself. I mean, I wouldn't be surprised to see, trust-like moments occurring in other developed bond markets where people just say, we just don't have a need for 30s. Like, we just don't.
So there's been some response, like the Treasury looking more at the front end and T-bills and them understanding that, and Canada's doing the same. Like, we didn't increase our long issuance. We didn't bring it down, but we didn't increase it. The UK doing the same thing. Just trying to pull away a little bit from 30-year issuance, knowing that this is a real risk.
Yeah.
Maybe that just delays the inevitable, because eventually you probably do
I
want to
think they're
turn
hoping
things
their
out.
stable coins are going to help them out too, to some extent, by taking
Some of those T-bills
short
down. Yep.
stuff off the thing.
That's
sure.
fair.
But then you've reduced your WAM, and then you have other issues regarding that, and there's still a lot of debt that has to be rolled over. I mean, Dutch pension reform is going to hurt the long end a bit, or starting to already hurt the long end. Like, I just think, the issuers can prevent exacerbating it by issuing less. But I mean, aren't you just like squeezing the balloon and pushing the air somewhere else? Like,
Yes. Then you create potentially other distortions. So if we get more curve steepening, and you tend to get a lot of supply in the first month of the year anyway. So I'm on board with the steepener in the kind of very near term for sure. But are we going to get front end rallying on rate cuts and the long end selling off?
that's what we saw the other day,
like,
and I think we could probably continue to see more of that. It's really hard to look at December and actually extrapolate anything, because things are already so thin. But it wouldn't surprise me, like, if we have another 50 to 75 beeps of cuts by the Fed, and the long end stays here. I think that would be a win.
Okay.
I would think, because I mean, maybe 2 years would only go down another 25 beeps or something, and the long end stays here. I would think that would be a win. I mean, steep curves are normal. The problem is, if you've got a president who says, like, we can't do this, we've got to do something about it. How do they get longer rates down without, let's say, losing the currency or other things? I mean, even like MBS spreads in the U.S. are way too high compared to historical, right?
Okay.
So maybe that's one way to get them down. I'm not sure, but I know that they want to get, they like to get mortgage rates down.
Yep.
And the only way to do that is to have confidence in your, in the Federal Reserve and the way the system works. And I think gold and silver and everything else is telling you that people don't have confidence in that, and they're worried about what's coming. So I don't know any better than anyone else, but I know enough to be worried.
Feels like more of the same in 2026 as we've had, at least through kind of the second half of 2025, is what you're saying.
Yeah, I mean, what could really blow the world up? China invading Taiwan. I think you'll get,
absent those things.
Yeah, well, I think you're going to get. I think Ukraine and Russia will have some sort of peace deal that will be shoved down the Ukrainians' throats, and they're going to have to take it. I don't know that
But that means
actually does anything.
You know what this is going to do? That's going to cut energy prices.
They're already hit a new low today.
Exactly.
$55.
This is why they're heading down, and that means lower inflation.
Yes.
That's the one thing that I kind of keep looking at. I keep watching my ticker on oil go lower and lower.
Yeah.
It's like, inflation's going to keep going down here.
But then we're at the point that the Saudis are starting to feel a little heat on energy prices. Trump needs low prices, because when you're complaining that inflation's high because your grocery bill is 30% higher over the last 3 years, he can tell you that at least at the pump, prices are under $3 or whatever
and it
it is.
contains other prices. It helps bring grocery prices, at least limit
the
grocery
transportation
inflation.
size, absolutely.
Exactly.
And there's no doubt he has an agreement with the Saudis to tell them they've got to shut up until November. And then come November, I wouldn't be surprised to see prices go back up, or at least
long oil in the last part of the year.
or OPEC saying we can't do it anymore, right? Like, at $55, people aren't making money. And then the Shell, the patch isn't making money. Shell doesn't make money at 55. I mean, it's a problem.
Okay.
But yeah, gas under $3. Woohoo!
It's all about inflation.
Vote for me.
It's still all about inflation.
The problem is, again, and I think we talked about this before. Nobody gives a crap about what the inflation rate is. What they care about is the price level.
Yep.
And that price level ain't going back down. So you can tell people mission accomplished, it's 2.1%, we're close enough, we did it. And they look and they say, I don't know what you're talking about. My healthcare, my education, and my food and a gas bill have gone way up. I mean, the data centers are causing energy prices to go up. Like, you can't, that's a reality. So
the only real solution is time. Time plus that level of inflation for 5 to 10 years will allow incomes to catch up and then allow people to feel better about themselves.
5 to 10 years.
That's what
my
it is,
God.
man. I know. Listen, if you want to fix the price level problem, that's the only way to do it.
Right.
Without something breaking entirely.
Well, you can't move real wages up too quick either, because then you have
5 to 10 years of compounded wage growth with 2% inflation and 3 to 4% wage growth, and there you are. Then people become happy. But
but no one has the ability. We can't wait.
That's a long time, man.
We can't wait 6 months for anything.
No. Says the guy who's been at BMO for 37 years.
I think it's 39.
39 years.
No, wait.
Whatever it
87
is.
I started.
A long time.
39 in June.
Okay, 39 years talking to the guy who's been at BMO for 20 years. So some people do have more patience than others, apparently.
Not people in control of things, that's for sure.
All right, Joel.
But other trade ideas? I mean, I have some concerns about the cross-currency basis market. I think as the Fed ensures that things like repo doesn't start to get out of control, that all of a sudden puts a cap on quarter end and month end and year end spikes. And we've seen it this year. This is the first turn that I think has wiped out millions of dollars of capital in the front end from guys hoping for the famous year end turn that's never happened. It's actually going the other way. Like UK year end turn is higher than it was last year by 14 basis points, like a substantial amount. And I think that will impact the basis curve. Probably your readers and listeners don't care enough about that, but
some of them do. I
do think it's going to change the structure. I would expect a much flatter curve in the basis market going forward, out to like 5 years or something like that.
Okay.
But I don't see a lot to do. I'm hoping that December brings some wonkiness so that we can take advantage of it.
2 weeks to go, and then we're off to a new year.
I can't wait.
Joel, thanks for coming on. Always appreciate it. And Happy New Year and happy holidays to all the listeners out there. And
hi, Mom.
Hope to be in touch in 2026.
Thanks, Benny. See ya.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.